everyone, Roxarmine here from HBCS, and today I am going to explain you International Standard on Auditing 510, which is related to initial audit engagements, opening balances. So in this video we are going to study ISA 510 purpose, its importance, objectives, scope, key definitions, some exam focus points, and its summary as well. So let's start with its purpose. Initial audit engagements opening balances. Before studying its purpose, let's study about what is auditing. Auditing is the independent examination of financial statements to check whether they are true, fair, and free from material misstatements. In simple words, auditing means checking the accounts of business to make sure records are correct, rules and standards are followed, and there is no major error or fraud. What is the purpose of ISA 510? ISA 510 guides auditors on how to obtain sufficient evidence about opening balances in an initial audit. In simple words, when an auditor audits a company for the first time, ISA 510 ensures that the opening balances that are assets, liabilities, equity are correct, they are properly carried forward from the previous period, they do not contain material misstatements that could affect the current year's financial statements. Opening balances include previous year's closing balances, accounting policies applied in previous years. So its purpose is to obtain sufficient evidence. What is sufficient evidence? Sufficient evidence means having enough evidence to be confident that the financial statements are free from material misstatement. What is material misstatement? A material misstatement is an error, omission, or fraud in the financial statements that is significant enough to influence the decisions of the users. Why it is important for the auditors? Because errors in opening balances can misstate current year financial statements and lead to a wrong audit opinion. So let's study its exam focus points, exam related short questions, and some MCQs as well. So you can get question in exam regarding ISA 510. What is ISA 510? Simple answer 8. ISA 510 deals with the auditor's responsibilities relating to opening balances in an initial audit engagement. Let's have a look on an MCQ as well. ISA 510 primarily deals with subsequent events, opening balances in recurring audits, opening balances in initial audit engagements, or current year transactions only. So the correct answer is opening balances in initial audit engagements. That is option C. Importance of the ISA. Why this ISA matters in audit practice? In a first time audit, the auditor didn't audit last year's figures, so opening balances must be carefully checked. It's linked with audit quality and compliance. Proper application ensures accurate comparative information and compliance with ISAs and ethical standards. What is its relevance in exam? Frequently tested when there is a new auditor, prior year audit opinion was modified, or prior auditor is not cooperative. Objective of the ISA. Official objective explained simply. To obtain sufficient appropriate audit evidence that opening balances are free from material misstatement, that there are no significant errors in the financial statements, in the opening balances. The auditor must ensure opening balances are correct and properly brought forward into the current year. So let's have a look on exam question. See, what is the main objective of the ISA 510? To obtain sufficient appropriate evidence that opening balances contain no material misstatement, like no significant errors that are affecting the current period. The main objective of ISA 510 is to ensure that opening balances are prepared using fair value, contain no material misstatement affecting the current year, are approved by management, or match the prior year tax return. So the correct answer would be contain no material misstatement that is affecting the current period. So let's move forward. Its scope. Situations where the ACCA applies. Initial audit engagements. When the financial auditors are audited for the first time, or when new auditor replaces the previous auditor. What this ACCA covers? Opening balances, consistency of accounting policies, prior year misstatements affecting current period. What this ACCA doesn't cover? Ongoing audits covered by other ACCAs, detailed procedures for current year transactions. Now let's study its key definition. Opening balances, amounts existing at the beginning of the period that are assets, liabilities, and equity. Initial audit engagement, an audit where financial statements have not been audited before or were audited by another auditor. Comparative information, figures and disclosures from prior periods shown with current financial statements. Let's have a look on exam questions. When does the ACCA 510 apply? If it applies when financial statements are audited for the first time or when there is a change of auditor. An initial audit engagement occurs when the same auditor continues the audit, financial statements are audited last year, financial statements have never been audited or were audited by another auditor, only interim accounts are audited. So option C would be the correct option, that is financial statements have never been audited or were audited by another auditor. So moving forward, key requirements or auditor responsibilities. Main duties of the auditor: obtain evidence about opening balances, verify that accounting policies are consistently applied, check whether prior misstatements affect current figures or not. Professional judgment and skepticism. Do not blindly rely on prior financial statements. Be alert if prior auditor gave a qualified or adverse opinion that financial statements are not true and fair. Documentation or communication. Communicate with the previous auditor if it is permitted. Document audit procedures and conclusions clearly. Practical example. For example, ABC Limited is audited for the first time in 2025. Inventory opening balance is shown as rupees 10 million. What the auditor should do? Observe current inventory counts, review prior year records and stock movements, perform cutoff and valuation checks. Linked to ACCA 510. These procedures help obtain evidence that opening inventory is not misstated as required by the ACCA 510. Common mistakes and risks. Frequent errors. Ignoring opening balances. Over-reliance on unaudited prior records. Not reviewing prior auditor's report. Consequences of non-compliance would be incorrect audit opinion and regularity or disciplinary actions. Audit failure or reporting risk. Material misstatement in profit or loss, that is significant errors in profit or loss, and modified opinion, that is qualified or disclaimer. Exam focus points. Keywords: opening balances, initial audit, comparative information, prior period misstatements. The most frequently tested areas are inventory opening balance, prior auditor's modified opinion, limitation of scope scenarios. What examiner expects from the student? Clear link between the risk and the auditor's response on it. Correct opinion if audit is insufficient. Its quick summary. ACCA 510 applies only to initial audits, not to the subsequent audits. Opening balances can affect current year results. Lack of evidence may lead to modified opinion. Overall purpose: to ensure opening balances are reliable and do not distort current financial statements. Its closing. Importance of applying ISA properly. Correct application protects audit quality and ensures fair presentation of the financial statements. Professional sign-off. Apply ISA 510 carefully to build a strong foundation for the entire audit. Thank you so much. Now let's have a look on some exam short questions. Which of the following is not an opening balance? Opening inventory, opening retained earnings, opening trade receivables, or current year depreciation? So obviously it would be current year depreciation. What is the main objective of ISA 510 is to ensure that opening balances are prepared using fair value or contain no material misstatement affecting the current year. What are opening balances? Opening balances are the amount that exists at the beginning of the period, including assets, liabilities, and equity. Why are opening balances important? Just simply answer it, because errors in opening balance can affect current year profits, assets, and audit opinion. That's all from my side. Thank you so much.